Sure, we are sorry for the unintended delay because there were a series of events today, and Yufi was involved in the events back to back. So we'll be waiting for a couple of minutes. Mr. Omar Mustafa Ansari will be joining us, Yufi Secretary General, and hopefully we can have more bigger participation. How many so far? We have more than 60. We have 61 participants. And hopefully this time we will have more concentration, bigger concentration from the Commonwealth of Russia, hopefully. Because we were in touch with Sister Medina and she was supposed to be part of this session today, but unfortunately she couldn't join us. So we hope that we have an enough number, a sufficient number of participation from the CIS region, hopefully. Again, we are very much sorry for the unintended delay due to a series of events taking place today, just back to back. So we'll be starting very soon. We would like to welcome all those people who have participated so far. And just a reminder that this session is being aired on YouTube channel, Ayufi's YouTube channel, for the convenience of those who couldn't or who cannot continue with us for long. It will be also there available. And for the convenience of those who cannot join through Zoom, please just help us spread the word, and share the link with those people who cannot join through Zoom. I think Ms. Amal Al-Masri also is joining us. Ms. Amal? Staza Amal, can you hear us? Actually, Ms. Amal Al-Masri is a board member, accounting board member of Ayufi, and she was also she took part in at the level of the working group for the development of this standard, particular standard, and the packet of standards that developed out of standard FAST 27. Most welcome. Assalamu alaikum. Ms. Amal Al-Masri. Good to have you. Alhamdulillah. Good to have you today, and as usual, thank you for your usual support and for being around throughout the entire process of the development of this set of standards related to FAST 27. Thank you very much.
Thank you for your
And today we'll be having Mr. Rostam. He is one of the key supporters at the level of his institution for sure, and at the level of Russia. Rostam Khitov from Russia. You are joining, sir, from Moscow?
Not exactly. No, I'm not located in Russia, but I was a member of this association when it was established and one of the key, very active supporters. So.
I see. So again, Russia or the CIS region, we are talking at that level, as we consider this region a vital, one of the vital regions for AOFI, where we are trying to establish connections and ties going forward, inshallah, at multiple levels, including standard implementation and capacity building and other substantial, initiatives of the kind. So hopefully we will have better ties going forward with your help and with the help of Ms. Medina and other brothers and sisters there.
I presume it is my turn to update a debrief on developments in Russia. Is this so just wanted to confirm before I go for this brief presentation. Mr. Bakir. So I presume that I'm giving the floor and
yes, sir. Yes, sir.
Okay.
Sorry for being away for a minute. Actually, we'll be starting very soon.
Okay.
Brother Omar, can we start at your end?
I think we can start. We have nearly 400 registrations, but the number of joining people is now, I can see 93. So maybe, but still, I think we should start. It's nearly 10 minutes above time, so we should start, I will believe.
Yes, yes. So, ladies and gentlemen, distinguished participants, dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh. It gives us tremendous pleasure to welcome all of you to today's public hearing session on a newly issued exposure draft of AOFI Financial Accounting Standard on quasi-equity, including investment accounts. This event is held in collaboration with National Research University, Higher School of Economics Russia, and Academy of BEPS and Association of Russian Experts in Islamic Finance Russia, being amongst our key supporters and partners in Russia and the broader CIS or Commonwealth of Independent States region. We would like to express our sincere thanks and appreciation to them for the substantial efforts and coordination put up towards the successful convention of today's public hearing session, inshallah. A word of appreciation also goes to Ms. Medina Kali Molina from the National Research University, Higher School of Economics, and a key AOFI supporter in Russia and beyond, who was supposed to join us today, but unfortunately couldn't take part due to a last-minute emergency. Please join us in welcoming Mr. Rostam Vakhitov, co-founder of Academy of BEPS, an educational institution on international taxation and an international tax experts, and also a member of Association of Russian Experts in Islamic Finance in Russia, who will deliver a brief introduction about the ground reality of Islamic finance in Russia and the status of AOFI's standards use and implementation at various levels, including the industry and the educational establishment. Mr. Rostam, the floor is yours.
Thank you very much, Mr. Bakir. Thank you to AOFI for ongoing support of the efforts to develop Islamic finance. I remember coming to AOFI in 2009 to ask for permission to make the translation of AOFI standards into the Russian language, which was kindly provided. And since then, we at Russian Association of Experts in Islamic Finance, and particularly Medina Kali Molina, was very involved and developed the full complete translation of AOFI standards into the Russian language, which contributed into the knowledge spreading across Russia and neighboring countries. So there is a long history of cooperation with AOFI. In respect of ongoing developments, it is very a remarkable time. As we speak, the first Russian law on Islamic finance is being in process of signing by President, and it, in principle, allows to conduct classical Islamic finance transactions by banks, by Islamic institutions, because prior to this there were some restrictions which are supposed to be fixed with introduction of this law, and further developments, further facilitation of Islamic finance in Russia. At present, the law will apply in 4 regions: Tatarstan, Dagestan, Chechnya, and Ingushetia, Ingush Republic, Chechen Republic. And in these 4 regions, the central bank and expert council in cooperation with central bank will try to establish the framework infrastructure for operation of Islamic finance and bring them in the same level playing field as the conventional banking, as what we saw in many other countries like UK and other jurisdictions in similar situation. What AOIFI standards are playing in this process? This is the most reliable source of information on how the Islamic finance transaction should be structured, and this is available because it's already in the Russian language, and institutions understand that this is the most common standard, like lingua franca. It's applied in many countries, and there is understanding that if the Russian developments will follow AIFI guidelines, they will be on the same, let's say, level, the same playing field as for the rest of the world. And there is strong understanding that implementing AOIFI standards, it is not done on legislative level, but at the level of business, industry. There is good understanding that this is the way to follow. And I'm looking forward for further trainings, for further information, for further dissemination on AOIFI, both standards and activities in the Russian language in this region, as it will help a lot to help the new opportunities to materialize, to develop. Because this is really, I remember when the whole process started 15 years ago, when we went to Bahrain to ask AOIFI for permission to do the translation. There was a lot of energy, there was a lot of expectations how this will develop. And finally, 15 years later, we have the law implemented, which gives the new opportunities. So I'm really enthusiastic to some extent, because the strong barriers which we had to deal with in the past, they are not there anymore. But of course, there is a lot of things to do with support of AOIFI, with support of international community, to learn how to build the industry. This is not just about how to sign the contracts, and the whole infrastructure should be in place, which will encourage best practices, which will discourage some inappropriate behavior of particular players. And in this respect, Russia has a lot to learn from other countries more experienced in this matter. I invite here all the experts, all those who are willing to share their experience and expertise, to cooperate with Russian Association of Experts in Islamic Finance and contribute to success of this new opportunity in Russia, as well as in neighboring countries. In terms of what is happening in economy, well, you all know about the ongoing situation with Ukraine and sanctions and counter sanctions. So many Western brands are leaving Russia, and they're being replaced by producers of food, clothing, technique from China, from Middle East, from other countries. The Russian business is also actively expanding, not through Europe anymore, but through Middle East, through other countries, which stay neutral, so basically which are not sanctioning Russian business in their countries or their business doing business in Russia. And it changes quite a lot of landscape of who supplying what, who are the buyers, who are suppliers, and there are many opportunities in this process which might be explored both in Russia and in neighboring countries like Kazakhstan, Tajikistan, Kyrgyzstan, which also have some experience in Islamic finance implementation, and maybe also be considered as a part of the whole region, of the whole system, if there are intentions to develop Islamic finance transactions strategic or regional wise. If I may demonstrate a couple of websites which are developed and to which I wanted to invite you to participate and explore. This is the website of Russian Association of Experts in Islamic Finance. So there is a Russian version, English language version, and Arabic version, through which you can follow on recent developments, on updates, and subscribe for the news. This is the website of Academy of BEPS, which is basically an online educational platform for training international tax. And this is the artificial intelligence database created on the basis of arrive materials. And this system may answer your questions in Russian, in English, in Arabic language. And here I just entered the question how AOIFI standards could help in development of Russian Islamic finance operations. And it provided list. Of course, it did not invent on itself. Artificial intelligence, it's not inventing something, it just processes information. And here there is a pretty to the point response that AOIFI standard can help in accounting, audit, governance, product development, etc. And I can give the instruction, repeat the response. And it delivers a response in Arabic. I'm not Arabic speaker, so I cannot appreciate how accurate is this, but this is very flexible and very efficient in terms of knowledge dissemination. So I thank you for the opportunity to deliver this brief update, and I'm looking forward for further cooperation in terms of both promotion and dissemination of information on AOIFI standards as an instrument of improvement of Islamic finance industry, in particular in Russia, in neighboring countries. And my expectation is with proper efforts, these legislative updates will create and provide for opportunity to make a real strong next step in Islamic finance economy development in the region and elsewhere. So that's pretty much what I wanted to share with you. Thank you very much. We'll be prepared to answer your questions, if any.
Many thanks, Mr. Rustam Vahitov, for your introductory remarks and the interesting facts you shared about country experience and latest developments in the area of Islamic finance and AOIFI standards use and implementation in Russia and the region.
Brother Mike, there are two questions for Brother Rustam in the question and answer tab.
Please.
Okay, so first question is from Brother Mizanur Rahman about how many Islamic banks do you have in Russia? So how many means like, again, we know that formal banking will start after the law, but as of now, what is the number of institutions offering different type of services? It might be a good information for our participants around the globe.
Yes.
At present, there are 10 to 15 institutions which cannot operate of full-fledged Islamic banks. So this is financial operations under special license, but do not be do not be disappointed by the amount, like up to 15, because so far there was no proper way of implementing Islamic banking in Russia. I do hope that the amount of institutions which will be involved in this experiment, so basically who will get the license to operate as a, let's say, partnership banking, will be between 50 and 100. Because there is a lot of interest, there is a lot of expressed so far to be involved in this industry. And also, you asked about Islamic finance banks. There are banks which are not really Islamic, but which have very strong units willing to develop these service lines, including Sberbank, which is the largest bank in Russia. They're very active, they're very supportive, and they're preparing to implement Islamic finance solutions. Akbars, this is the largest, or one of the largest banks in Tatarstan, where this experiment will be starting. And this is the bank which did the first Islamic finance transaction in Russia in 2011. They did Sukuk transaction. And they're also very supportive of this. So there will be a significant number of players involving in this experiment. And if there is interest to establish cooperation, we will be happy to facilitate.
Thank you very much, sir. I think the second question is a very quick one that some of your colleague may put the, they want the website address. So if somebody can put the website address in the chat window, so it will be like, useful for everybody. So in the chat window, any of your colleague can put the address of the website for the benefit of our audience, which has joined from the global. So that is the second point. Third is about, I think the third question is about asking for social financing. It's a starting phase. So I think this question is not that much relevant now. From Brother Isa Al Mansoor, this question about social finance and all that. I think it is too early to ask for. First is that they should be able to actually start formally the Islamic banking after the passing of law, inshallah. Thank you very much. I think these were the three questions. Brother Masht, you can take it forward, please.
Thank you, Brother Ahmad. Thank you very much, and thank you, Mr. Rostam, again for the introductory remarks and for answering the three questions. Thank you very much. We hope that at the level of Russia as a country and regional level, Islamic finance will gain an ever-increasing traction, inshallah, at the present and in the future. Ladies and gentlemen, distinguished guests and audience, the public hearings are one of the key steps in or stages in standard development, the so-called due process carried out and undertaken by IOFI, and constitute an opportunity for us to interact with and benefit from the knowledge, experience, and wisdom of professional individuals and experts like you on the new exposure drafts of financial accounting standards. As exposure drafts may have far-reaching effects, the input received at such interaction events would be more critical for us to ensure that the final standards do properly address industry expectations without compromise on Sharia precepts. Today's exposure draft represents one of the key outputs of the revision project conducted under supervision of IOFI Accounting Board on FAS Financial Accounting Standard 27 investment accounts, aiming to enhance the financial reporting requirements for participatory investment instruments that establish control for the institution on behalf of certain stakeholders other than equity holders or the what we know as owner's equity, as well as other relevant areas that have been tackled under other exposure drafts. This IOFI Financial Accounting Standard sets out the overall criteria for on-balance sheet accounting for participatory investment accounts, investments and accounts and quasi-equity, as well as pooling, recognition, measurement, presentation, and disclosure for quasi-equity. Before we move on, I would like to welcome to this session Ms. Amal Al-Masri, IOFI Accounting Board member. Thank you, Ms. Amal, for being with us today. I would like also to remind you that this session is being broadcast on IOFI's YouTube channel for the convenience of all those interested who couldn't join us or cannot join us by Zoom. All comments raised and opinions expressed during the session will be minuted by our team for submission to the respective working group for further discussion and a likely incorporation into the draft standard that will be forwarded to the IOFI Accounting Board for its consideration. Those who want to share their comments and remarks in writing can drop us an email over accounting@iofi.com. Our colleagues also will share the email address. And now let me invite to the virtual floor Mr. Omar Mustafa Ansari, IOFI Secretary General, who will present the exposure draft and walk you through its main content and structure while answering your questions in an interactive session. Over to you, Mr. Omar.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Ladies and gentlemen, particularly my dear brother Rustam, my sister Amal Al-Masri, and all senior people who I can see in the list of participants. Assalamu alaikum wa rahmatullahi wa barakatuh, and good afternoon as per our time, and good morning and good evening as per your times. Thank you very much for joining in, and thanks particularly to our partners for today's events for the European and CIS region. And thank you for being with us in all these initiatives, all these activities. We believe that overall, the standard setting process and the standards implementation, the whole ecosystem cannot work without our partners like you, who are actually taking it forward from us and taking it towards the implementation part. Thanks again for reminding us about the Russian translation thing. MashaAllah, that was a great initiative. I believe that we have been recently in talks about update of those translations as well, because there were some new standard issued. So I believe that the updated version will also be coming up soon. I hope so. So with that, without taking much time, I'll take everybody to the topic of today's discussion, that is the exposure draft on quasi-equity, including investment accounts. And again, this is a huge project that we are doing right now. Some of you might already be aware, because we have been doing some public hearings on some of the programs related, some of the exposure drafts related to this larger project. Actually, probably will be coming out as 4 total standards actually as a result of this comprehensive project, 3 as a direct outcome and 4th as a related outcome. So the financial accounting standard 27, which is there, will be replaced with mainly, this is the major chunk. This is standard that we are talking about today, inshallah, is the major chunk of the standard that replaces FAS 27. The off-balance sheet investment accounts related part in FAS 27 will be replaced by the FAS off-balance sheet investment accounts standard, on which we already held, I think, 1 or 2 public hearings. The control element is important, which has to be covered in this standard as well as some other standards. So we have decided to bring it to one place. That is already, has gone through, I think, 2 of the public hearings. Maybe there are so many public hearings happening these days, maybe I may forget the numbers. So maybe Brother Majd may correct it, but I believe that for quasi-equity, this is the first one. Am I right, Brother Majd?
This is the first in English, in Arabic one.
Sorry?
There was one in Arabic, and this is the first in English.
For quasi-equity. Okay. The Arabic one was conducted first. Okay.
Yes.
As you might all be aware that as a matter of policy, we are actually holding public hearings in English as well as Arabic for all our standards. And inshallah, this will be an ongoing practice. This project, I would say it's a huge project, is intended to be finalized before end of this year. which will actually be nearly the end of the term of the board as well. So it is our target that this is finalized within this year, inshallah. So we'll try to complete the remaining public hearings as soon as possible, and we'll try to finalize them, all these standards before the end of the year, inshallah. The reason why we are actually revising FAS 27, while FAS 27 was comparatively a newer standard, if you see, I would say there are three main reasons. The first one is that in between we have revised our conceptual framework. That is one. Number two, we revised the financial accounting standard number 1, which is about general presentation in the financial statements of Islamic financial institutions. And one of the parts of FAS 1 actually addresses with regard to the Islamic banks in particular and similar institutions. In the statement, in the framework and in the financial accounting standard number 1, some new concepts were brought in, and some of the, like for example, the concept of having a quasi-equity related statement, and some terminology was improved, some of the conceptual guidance was improved. In principle, I would say there is no change, because these are some of the core principles which remain unchanged. But with regard to the alignment with the new framework, with regard to the alignment of new FAS 1, with regard to the alignment with certain other new standards, it was considered necessary that we do a limited scope revision of FAS 27. But when we started the limited scope revision for this alignment purpose, we identified there are some other improvement areas as well. Like for example, I touched upon the concept of control, that in between in the new framework and in some other standards, we clarified the concept of control. So it became more important that because this standard talks about on-balance sheet versus off-balance sheet investment accounts, and there are issues related to al-wakala bil-istismar as well, which has already been issued as a separate standard FAS 31. So considering all these things, the concepts related to control and some other alignment were needed. Even alignment with FAS 31 was needed. In a nutshell, all these things combined made it, instead of a limited scope revision, made it a much bigger project in which we have comprehensively now revised these standards. This standard, as I mentioned earlier, is the major chunk of the project, which is the major outcome of the project. If you ask me, Umar, what is changed with regard to urea? In a nutshell, I'll say to you that there is no principal change. But if you ask me the number of changes, there might be a long list which I cannot recall all of them, because some of them I mentioned to you are regarding alignment with the newer standards and newer framework. And in addition to that, there are a lot of improvements with regard to certain issues which were there, which were not addressed earlier. So we have tried to address some of those issues. So some of those issues are addressed in this one, some are addressed in control standard, some are addressed in the transfer of assets standard. But even in this standard, certain improvements and some additions are there which were not there in the earlier standard. It is more or like a quick summary of what are the major changes and the objective of those changes. So I'll share the screen now, and I'll try to skip the first few sections which are related to the preface and the introduction part. With regard to the significant changes, I'll like to take you through very quickly, because again, as I said, it's a long list, but this is a comparatively smaller one. Only the principal changes are there. So first one, as I mentioned, conceptual framework and FAS 1 are aligned. Broader concept of quasi-equity has been incorporated. Now, this is a major change because the new framework and new FAS 1 actually talk about quasi-equity. AOFI's treatment for these type of assets balances has not changed since beginning of AOFI. So some of the initial standards were actually talking about these parts. Standard number 5 and 6 were also talking about more or less the same treatment, which were replaced earlier by FAS 27 and now being replaced again. So the conceptual part is still there, that the investment accounts, particularly the unrestricted investment accounts, are a special type of equity which should not be mixed up with the common shareholders' equity, but to be shown after equity and before liabilities, because they are not liability as per Sharia, and they are not equity equivalent to the equity of the shareholders because of different reasons. We will come to those differences in the definition of quasi-equity that we'll discuss later. So in a nutshell, the quasi-equity is a broader term which include, in addition to unrestricted investment accounts, which may include some other instruments. Again, further details will be there in the standard as we go through it. The requirements related to off-balance sheet assets are moved to the other standard. As I mentioned already, the criteria for quasi-equity is clarified and referred to with control of assets and business. This is an important point. Additional guidance as considered necessary is provided in respect of certain treatments and disclosures. Sister Farida, if you can just make a note of it, there is a typo error here. E is appearing twice. I just believe that it might be there in the presentation, not in the body text of the standard, but just being on a safe side, just check with the body text of the standard as well.
Okay.
Okay. So we have aligned with the new FAS 31, which is related to Wakala Istismar, and provided some minimum guidance with regard to the commingled Wakala with Mudarba. Accounting requirements have been defined at the level of investment pool. This is one of the things which were not earlier very clear. So this is one of the additions and improvements that we have discussed about investment pool in more detail, and some of the requirements we have addressed there. The alignment is also done with impairment of assets and risk reserves standards, because risk reserve standards is directly related to these investment accounts, and even the allocation of impairment, credit losses, and onerous commitments, which is related to the investment accounts, was earlier partially discussed in FAS 27, which is now covered in FAS 30. So we have aligned with that and avoided any redundancy risk. And some additional guidance has been provided for disclosure of such a specific aspects such as HIBA and gifts and incentives, etc. as well. Coming to, again, this is a common question that we receive every time. So just a quick answer before you ask that question, that this presentation is only a reflection of what is there in the text of the standard itself. The standard is available in form of PDF. I would request our colleagues to put the link to the standard in the chat window, if it is not already provided. If it is provided, please confirm to me. And then, we'll not be sharing the PowerPoint slides, because these are only for, for presentation purpose, and these are exactly the same as per PDF version. Objective of the standard is to establish the principles of financial reporting related to instruments classified as quasi-equity, such as investment accounts and similar instruments invested with Islamic financial institutions, the IFIs, the institution. The quasi-equity is an element of financial statements of the institution in line with the AOFI's conceptual framework. Scope. The standard shall apply to all instruments that meet the definition of quasi-equity in line with conceptual framework held with the institution, including, for example, the investment accounts based on Mudarba contracts, including investment accounts that are placed for short term, such as overnight, 7 days, or 1 month basis. Sisters Farida, no comma before or. Just make sure writing style consistency. The investment accounts or similar instruments based on Musharka, Shirkatullah. So Musharka, this will apply on Musharka-based deposits also, because this is a common question to us. Sukuk, we need to see paragraph 39 and 41, because it will not apply to all Sukuk. It will apply to Sukuk in addition to the Sukuk accounting standard, which is already there with regard to any Sukuk that meet the definition of quasi-equity, and particularly those which are commingled with quasi-equity or are linked with the investment pool. So there are some of the requirements which are there. This is one of the areas where we would like to learn more and get more input from the industry. And one of the questions let me ask to all the participants today, that what are the challenges with regard to the accounting, reporting, and disclosures for tier 1 and tier 2 sukuk, which are issued linked with the main investment pool of the investment accounts. This is some of the challenges we have seen in recent past with some of the institutions. I have seen some of the issues in my capacity other than AOFI as well. So this is one thing on which I would like to ask all participants to provide their comments now or in writing when we reach that point. But the point is that this is a weak area of Islamic finance where sukuk, which are linked to the investment pool, have some treatment, governance. Obviously, we are working on a governance standard on this area at the same time. So it might be quite relevant if you can provide your comments, even related to governance side to us, which we can forward to the respective working group and to the board with regard to the governance part of the investment accounts. So even if you have any significant issues or comments on the governance elements of investment accounts, Sharia compliance and governance elements, please feel free to provide all those comments today or in writing, because as a comprehensive project, we are working on the governance side of the investment accounts as well, and we'll try to incorporate your comments there. So please feel free to provide all those comments. So one of the aspects that I was asking was with regard to the sukuk, which are tier 1 or tier 2 sukuk, and which are issued in a manner similar to investment accounts or are linked directly with the investment accounts related investment pools. So please provide input on that part. This is one of the most important elements from the public hearings and the public comments that we would expect to add value to the current version of the standard before we finalize it. Then again, I'm not going to read all of it, but in a nutshell, the investment accounts which are commingled between Wakala Bil Istismar. If you recall, in the Wakala Bil Istismar standard, that is FAS 31, financial accounting standard for Wakala Bil Istismar or investment agency, that actually that has a para 37, which addresses a situation that generally speaking, the Wakala Bil Istismar is considered to be not in control and hence is considered to be off balance sheet. But there are situations where the investment account the accounts which are based on Wakala are commingled with the investment accounts which are based on Mudarba. And according to our standard FAS 37, FAS 31, para 37, the commingling is a multi-level investment arrangement, and that multi-level investment arrangement makes it on balance sheet because of Mudarba, Mudarba being on balance sheet and Wakala investing in the same investment pool. AOFI Sharia standard on Wakala Bil Istismar also allows this thing. So from that perspective, we need to understand that this is a very complicated area of accounting, and we know that some of the countries have challenges in that, like Bahrain. Actually, instead of keeping them off balance sheet, actually Bahrain Central Bank had issued a circular that mostly all of the Wakala investments shall remain on balance sheet by this commingling mechanism. So we need to understand more issues which are actually being felt by the industry on this part, but we try to clarify some of the requirements which are related to this, because that paragraph 37 might not be enough. And actually we had issued recently we had issued a technical release on that part as well. We were doing some technical release and on this clarification part, so some of the aspects of those technical release will also be incorporated in this one. I can see a question in the Q&A tab. Brother AKM Mizanur Rahman. Assalamu alaikum, Brother Mizanur Rahman. It's always good to have you here in our public hearing. Since URIA is quasi-equity in nature, it is not the liability of the bank. So should a bank maintain SLR or CRR against the URIA? The question is that while we fully agree that it's not a liability as per AOFI, but the question is that AOFI does not ask, because we have not developed the regulatory standard. So we have not asked the regulators not to put a SLR requirement or CRR requirement against URIA. If you ask me, particularly, I personally believe that there must be SLR and CRR requirements against URIA. But the ratio, the ratio of SLR or CRR may be different as compared to liabilities. Now, why I believe it should be maintained? The reason is that if we go to the definition of quasi-equity, the definition of quasi-equity actually means that it has a put option. So having that put option, we'll discuss this thing later. So having this put option actually makes it necessary to have SLR and CRR. We'll come to this point when we discuss the definition in detail. Although AOFI does not develop the regulatory standards and we normally endorse and support the IFSB's standards, but from this perspective, at least our stance is clear that this is not a liability. But I believe, and I'm saying my stance because as AOFI we do not issue the regulatory standards, so my stance is that yes, SLR and CRR should be there. Further discussion can be done when we discuss the quasi-equity definition and other relevant topics. Thank you very much, brother, for your very good question actually. The standard shall not be applicable to the following instruments or contracts of financial nature: equity instruments, managed investment funds, which are a separate legal entity. So, for example, if there is a separate mutual fund which becomes a legal entity, that will be subject to relevant AOF FAS, that is FAS 14 for now. FAS 14 is also being revised, so the number will change, but the requirement will be subject to a separate standard. So, if you have an investment fund, which becomes a separate legal entity, then you apply FAS 14. You do not apply FAS 27, or you do not apply the new versions of FAS 27, that is the off-balance sheet investment accounts and the quasi-equity account, because that becomes a separate legal entity. So it is a small financial institution which is subject to accounting for itself under the relevant AOF FAS. I hope the question is this part is clear. Off-balance sheet assets under management, for example, off-balance sheet investment account based on restricted Mudarba accounts and Wakala bil Istismar contracts other than those referred to in paragraph 2D, and different types of liability-based products, deposits, or instruments, for example, current accounts, Muraba, commodity Muraba, Tawarruk, or similar contracts. Coming to the definition, I will not read every definition, but I'll come to the more relevant definitions. Agent remuneration is coming from FAS 31. Commingled Wakala bil Istismar funds is important. Are the funds of principal maintained by the agent through a multi-level investment management arrangement, whereby such funds are invested in the investment pool managed by the agent on a Mudarba basis with other investment account holders. So this is where this commingled Wakala fund will become subject to requirements of this standard instead of, in addition to the requirements of FAS 31, not instead of, in addition to. Control we have defined in a separate standard. Current account, I'm not going for detail. Investment agency, investment pool. Investment pool is important definition. I think we discussed in the transfer of assets standard as well, but I think we need to mention it. So investment pool is a virtual entity, at times a separate reporting entity, comprising of distinct assets whose risk and reward wholly or proportionately are attributable to the funding provided by respective quasi-equity investors. IRR definition is coming from other standard. So FAS 35, so I'm not going in detail. Mudarba definition, I think we have updated in this one, so let me read. Mudarba is a profit-oriented participation between capital and work. Explanation. Generally, in the context of an institution, it is conducted between investment account holders as owner of capital and the institution as Mudarib. The institution announces its willingness to accept the funds on investment account holder, funds of investment account holders, the sharing of profits being as agreed upon between the two parties, and the losses being borne by the owners of the funds, except if they were due to misconduct, negligence, or violation of the conditions agreed upon the institution. In the later cases, such losses would be borne by the institution. Sister Farida, just a quick note for internal purposes only. The font size has been reduced here, I believe, which should not happen because then it's not easy to read for all the participants. Yeah. Okay. For the people, so we have to keep it consistent font size. If you need to take it to 2 pages, there is no harm in that. On balance sheet investment accounts, let me read it because this is the new, because these are the relevant ones for this standard. On balance sheet investment accounts are the participatory investment accounts whereby the institution controls the underlying assets in line with the requirements of the AOF phases, including in particular unrestricted investment accounts. So we are talking about that most unrestricted investment accounts are on balance sheet investment account, but there can be other structures as well. Participatory investment instrument, commonly referred to as account, that is participatory investment account, is an instrument held by an investor under profit loss sharing or taking arrangement, for example, Mudarba or Musharka, representing funds received by an institution for investment on behalf of the investment account holders with or without conditions as regards to how the funds may be invested. So if the conditions are there, restrictions are there, then it becomes restricted. Otherwise, it becomes unrestricted. So both can be there, whereby the holder of the instrument is entitled to the residual interest in the underlying assets. This is the most important condition, that the residual interest in the underlying asset, that is the profit, loss, and any net figure that remains there in the underlying assets, is making it a participatory investment account or participatory investment instrument. So why we mentioned about instrument and account both as option. So for example, you can find in some places there are certificates of Musharka, some places you can find certificates of Mudarba, and more commonly in some countries they call it a PLS deposit. In some countries they call it a urea, that is unrestricted investment accounts. So we have tried to come up with the broader terms, that is participatory investment instrument and on balance sheet investment accounts. The purpose of coming up with these more like broader terms was because the Islamic finance industry has grown many folds in past several years. So we do not want to just keep the terminology limited to urea or RIA. Rather, we want to have the terminology which is broader and which covers most of the aspects and most of the instruments that can be there. Profit equalization reserve, the definition is coming from FAS 35. We are not changing it. Quasi-equity, the definition is there in the framework in the FAS 1. We are not changing it, but I'm going to repeat it because this is all about this standard. So it's very important to repeat the definition, particularly for the benefit of those participants today who have not actually read earlier standards. So quasi-equity is an element of the financial statements that represents participatory contributions received by an institution on a profit sharing or participation basis. It has primary characteristics of equity, that is in the case of loss, unless negligence, misconduct, breach of contractual terms is proved, the institution is not liable to return the lost funds to the fund providers, and the fund providers share the residual interest in the underlying asset or business. So the first thing is that it has primary characteristics of equity. The second thing is certain characteristics of a liability, that is it has a maturity or a put option of redemption or liquidation. Now, Brother Mizanur Rahman, I would come back to your question now, that since quasi-equity has certain characteristics of a liability, particularly with regard to having a maturity or put option of redemption and liquidation. So from that perspective, there is always a chance that there will be some of your customers who will come to you and say, we want to encash our deposits. Some of them will come even if you have time-bound investment accounts like 5-year maturity, 3-year maturity. Still, the customer may have a right to get it matured, and you will have to mature it immediately or within few days as per the contract. So it means that the SLR requirement and the CRR requirements are still relevant. But as I mentioned, I believe they might be different. Similarly, the capital adequacy requirement, that because these parties, the quasi-equity actually takes a risk on the underlying assets. But the point is that as a market practice at time, profit smoothing techniques are used, riba is used. So considering those things, I believe, and we as AOFI endorse the IFSB's view with regard to the capital adequacy, that there should be an element of alpha, like, that to keep, on an ideal basis, on a high risk investment accounts where the whole risk is taken by the investment account holders, the alpha may be like, 0. But considering the normal practices with regard to the investment account, there can be a alpha even up to 100% where the bank actually takes like, some measures to smoothen the profit. So considering those things, the capital adequacy and statutory liquidity requirement and the cash reserve requirement, all these things we believe are to be kept, but not exactly like conventional deposits, because the structure and the characteristics of these are different. So that the amounts and ratios that are required for capital adequacy, for SLR, for CRR, these all should be different. I can see another question in the Q&A tab, again by Brother Mizanur Rahman. We know IRR is kept to protect the capital of Rabbul Mal. When IH pull out his fund that is close to account, what would be the fate of IRR that was taken as a reserve from his profit? Should the bank release proportionate amount of IRR? Brother Mizanur Rahman, the quick answer to your question, should the bank release proportionate amount, is no, because it is kept for collectively for all investment accounts for a longer period of time. So if he continues, he get back the return. But if he leaves, then it means that he's also leaving his assets there and selling his assets to others, which have a risk element carrying forward. So from that perspective, IRR and PR are to be kept. Right now, this is, again, This is a very vast subject. The investment accounts is a very vast subject, and if we go into more detail in this discussion, we'll actually enter into the domain of FAS 35, which is already there. So I do not want to go into domain of FAS 35. In a nutshell, answer is yes. Yes, it is related to his risk, but it is not released because of the contractual arrangement under which the investment account holder agrees to keep PR and IRR related to the overall pool at the time when he leaves. So it is more like, let me give you an example that, for example, if a shareholder sells his shares to another shareholder, so what happens that his actually reserves which are maintained there, which are not paid to him in the dividend form, those are reserves, those are still forwarded to the next investment account or shareholder. So here, if you encash as a bank, you encash the investments. So normally those are filled by upcoming investment account holders or by the bank itself by its own investment. So from all perspectives, still it is relevant to keep the investment accounts related IRR and PR continuing in the account for the long term. Otherwise, the objective will fail. Every time a person goes away, you give his PR, IRR, the objective will fail. So again, I will not, I know that my answer may not be sufficient for some of the participants, but it will, if I go in more details, it will take us to the domain of the other standard, and maybe the time for today's standard might not be enough. So thank you very much, Brother Mizanur Rahman, for a very good question. And my apologies for not being able to go in more details with regard to the PR and IRR related issues. My pleasure, brother. A reserve is a component of equity that is pertaining to shareholders or non-controlling interest, or quasi-equity that is pertaining to participatory stakeholders as participating. Sister Farida, please make a note. It's participatory stakeholders, not participating stakeholders. Okay, it's a typo error. Sister Farida, can you make a note of it, please?
Yes.
Okay, thank you very much. Because it has to be participatory stakeholders. I think it's a typo error, or at times Word does his own editing. So we have to be careful about it. Participatory stakeholders set aside by the way of appropriations from respective earnings or retained earnings, as well as comma before and after. Please make a note of it. Value adjustments for the benefit of such respective stakeholders by way of managing various risks posed to such equity or quasi-equity balances or off balance sheet items. So, Brother Mizanur Rahman, the point is, again, I'll come to your part, that it says set aside by appropriation from respective earnings. And this will come back only when collectively the pool needs it, not the individual customer. So when the individual customer needs it, you will not give it to him. But when the investment pool needs it, you will return it back to the investment pool. Now, we are moving to the next section. So any questions with regard to the scope, objective, definitions, introduction, rationale, whatever I have mentioned? Do we have any questions, or shall we move ahead? Okay, you can put your questions as you like. I'm just moving ahead. Again, today I'm afraid that time may not be enough. I can now see a hand raised by Brother Sayyid Abdul Fadil. Thank you very much, Brother Sayyid, for raising hand. Unfortunately, I feel today this is a very long standard, and the time may not be sufficient to allow questions by, if towards the end we have some time available, we can take the questions by audio. But as of now, can I request you kindly to put your question in the Q&A tab, please? I'll just request the team to keep note of the names who have raised their hands, so that if they, in the end, we can check it towards the end, that if we have time available, then we'll try to get some of the questions by audio as well. There is a comment from Brother Muhammad, mashallah. What is Mudarba in detail? Brother Muhammad, actually, as of now, this standard addresses the definition of Mudarba and the practical application in one form of Mudarba, that is the investment accounts. It is not discussing in detail the Mudarba, which is addressed by AOFI's Sharia standard on Mudarba. Some of the aspects are covered in the Sharia standards of Sharia standard of AOFI of investment accounts. Some of the aspects are covered in accounting standards on Mudarba. So in a nutshell, we cannot go in more detail about Mudarba right now in this standard because that is subject of multiple AOFI standards. Further guidance, mostly the further guidance is available in the Sharia standards. According to AOFI standards, all the AOFI standards in the beginning, they say that this standard is to be read in accounting standards. They all say that it's to be read in conjunction with the AOFI relevant Sharia standards. So from that perspective, we do not repeat a lot of things in the standard which are already given with regard to the structure, with regard to the profile, with regard to the implementation and execution requirements with regard to the respective product. So this standard should be read along with FAS 3, along with the FAS 3 on Mudarba, along with the Sharia standard on Mudarba, Sharia standard on investment accounts, because all of the things can't be at one place. And again, if we go in more detail in this topic right now, my worries are that we will not be able to complete the content of this standard. So thank you very much for your kind question. And I would suggest some of the colleagues, Sister Farida, Sister Noof, if you can provide a link to the Sharia standard on Mudarba, Sharia standard on investment accounts, and FAS 3. Okay. I'm sorry. Okay, so now classification of investment accounts and other instruments on on-balance sheet versus off-balance sheet. So when you open investment accounts, when you offer investment accounts, the first thing is that you need to consider their nature of, and this nature will be determined, the classification and nature will be determined based on whether you have the control on those assets or do not have the control on those assets. Now, what is the control definition? Control definition is that you need to have the variable returns coming out of management and control rights on that. So you need to have the power to govern. You need to have variable returns, which means variable return means profits and losses, and not fixed profits, but rather variable profits and losses. And then you have, the variable returns should be there for you in a form that you use the governance and management rights for your own benefit. So this is the control definition in a nutshell. So on which now we have a fully standard of means exposure draft of a fully standard. And so now we are not repeating control related requirements in each of the standard unless something is very specific to that standard. So on control of asset and business, we have already conducted public hearings. I think 2 of them are done or 1 of them is done, but I think there is at least 1 pending. So you may attend that one later as well. Right now, again, I would say it's a very long subject. Even today, I think I have more than 70 slides, which I'm afraid I'm not sure whether I'll be able to address those all today or not, because this is the longest chunk of the project. So from that perspective, my apologies will be there that I'll not be going in all details with regard to the control and other subjects like off-balance sheet investment account and other subjects which are addressed other one. So in a nutshell, you establish control. That yes, we control these investment accounts related underlying assets. If you control the underlying assets, it means that it's an on-balance sheet investment account. On-balance sheet investment account means that this is to be accounted for in line with this standard. If it's an off-balance sheet investment account, then it is to be addressed according to the requirements of other standard. Judgment of control of the institution. The judgment as to whether investment accounts and other instruments are on balance sheet is primarily based on establishing whether the institution has control over such investment accounts and other instruments. The institution shall make the judgment whether assets and accounts, including underlying assets of the participatory structure, are under its control in line with the requirements of respective AOFI FAS, while duly considering the following factors into account. A, returns generated by the available funds. B, frequent transfers of funds between owners' equity and investment accounts. C, investments commingled with those of our investments. And refund of funds to investment account holders and amounts that are in excess of their cash equivalent value. So these are some of the factors that are to be considered. Sister Farida, can you just make a note of my own comment, please?
Yes, Padma.
These factors are to be aligned with the table 1 in the control standard also. Okay. Just we need to make sure that we don't miss out anything. These are the additional factors, but the factors which are mentioned there should not be missed out. Okay.
Okay.
Okay, off-balance sheet assets, I mentioned already that they will go in separate. Now, what happens for off-balance sheet? It does not mean that you do not account for them or do not disclose them. Only thing is that they go to a separate statement, which is related to a statement of off-balance sheet assets under management. Now, coming to pooling of quasi-equity. The participatory investment instruments of quasi-equity nature, including on-balance sheet accounts, shall be classified and pooled together in one or more investment pools. Each investment pool shall have distinct assets, liabilities in rare cases, revenues, including gains and expenses, including losses, as well as distinct sources of funding, including quasi-equity and owner's equity where applicable. Sister Farida? Again, I have something just came to my mind. Just make a note for my for the working group that using the term pooling of quasi-equity, people may consider it like, put the term pooling at times is used for combining. While here we are talking about allocation to different investment pools, so maybe we need to change the heading by calling it allocation of quasi-equity to investment pools. Because simply, because a common pooling, the term pooling actually have different connotations at time in use, where a common man can think of, and actually it came to my mind now that it could be thought of as combining of pool quasi-equity into different things or with each other. Rather, we are talking about allocation of quasi-equity to investment pools. Okay.
Yeah, I'll write it down. Allocation of
Just make it as my own note, please. Today we are not getting too many comments from the people, so maybe I'm going to give all comments myself. So let's wait for let's hope for some more comments coming in. Actually, we have a very good number of participants today. We have 114 participants I can see, but they are quite silent. Maybe it's afternoon time. Most of them have taken lunch and want to have a good nap. But let me assure you, it's one of the most important standards, and it's going to impact all of you, like all banks, all even regulators, auditors, accountants, system providers. Everybody will be affected by this standard. So my suggestion that things should be more clear. I could see our brother Nomanul Hassan in the list of participants from IMOL Essential as well. I think that these requirements, which were not very clear in the earlier standard with regard to the investment pool, etc., and the governance standard that we are working on, and we are clarifying these aspects. I think this is something very important for you guys. Even the system developers have to take note of these points, that how these requirements are to be there, because actually some of these things were like sort of understood and part of good practices, and a lot of institutions were doing them, but probably as the Islamic finance industry grows, there are things which are more which are becoming more a matter of concern and are need to be clarified in more details in the standard. And particularly because this pool accounting actually has impacts on the accounting and financial reporting as well. So from that perspective, we have defined this part as more clear as compared to our previous standards. Each investment pool shall have distinct assets, liabilities in rare cases. It may have liabilities, revenues, including gains, and expenses, including losses, as well as distinct sources of funding, including quasi-equity and owner's equity where applicable. Owner's equity may be contributed to an investment pool either directly or through equity, including through reserves or through other funds available at owner's disposal being under their liability. For example, current accounts. So if I'm the shareholder and I have taken some loans on a guarantee basis, it means that I will have to I'll have to return them in full. So if those funds are used, then I am entitled to use them. I'm entitled to use them if the contract allows. I'm entitled to use them as equity within the pools. So this is again one of the things which was even earlier standard was asking about only a disclosure on this part, but we have here clarified more as to how it will appear in how the equity appears in the quasi-equity, and that pooling part is important. There is a one comment in the question and answer box. There is from anonymous attendee. So first thing is always I request that kindly put your name in the, so you can always rename yourself in Zoom. So please rename yourself so that we know your name. And the question is, should transfer in assets between pools be on market value, face value, or book value? It's an excellent question, but at the wrong, a bit wrong place. Means that we have held public hearings on the transfer of asset standards. So first answer is, it is on the wrong place for two reasons. One is because that standard is different, and second is because on what value the transfer takes place is a business and Sharia decision, not an accounting decision. While what values are to be disclosed and how those values are to be calculated is the accounting issue. So as accounting, we cannot impose that it should always take place on face value or on market value. On the other hand, what we have done in the transfer of assets standard, again, I do not want to go into all details related to transfer of assets standard because itself is a complete standard. Already there is a standard and now we are improving the improved version. Again, I would request that the team to provide you the link to the transfer of assets standard. But in a nutshell, what we have said is that transfers are generally expected to be at fair value, not market value, fair value, but you cannot transfer everything at fair value. For example, if the transfer includes a debt, as per Sharia, it cannot go in fair value. But if it is part of a bundle, then the whole bundle can be transferred on fair value if the tangibility ratio is maintained. So there are more complications to your question, and that's why this whole question needs a whole standard actually. Now, in the accounting side, we cannot impose fair value on the transfer side because transfer is a business matter. On accounting, we can tell you that do the accounting of something on a fair value basis. But here we are, what we are saying is, nutshell, you do the accounting based on Sharia requirements and based on contractual requirements. And in the event the values are different from the fair values, disclose the difference and the reason. So these are the contents of our standard on transfer of assets. I can see a comment. Assalamu alaikum. This is Faisal Mehtab, PhD scholar, GC University Lahore. Welcome, brother Faisal Mehtab. I think it's you have now renamed yourself. That's why you have mentioned. Thank you very much and welcome. Your question is excellent, as I mentioned, but the point is that it itself needs a full standard, and that's why you need to refer to the respective exposure draft of the standard. And we would love to have your comments on that as well. Thank you very much for being with us today. The institution shall allocate each investment account to a specific investment pool at the time of initial recognition. See paragraph to this. Similarly, whenever a new financing or investment asset is created, the same shall be allocated immediately to investment pool or to the owner's equity, depending on the sources of funding used or allocated. In case of transfer of quasi-equity instrument or underlying asset from one investment pool to another, the requirements of respective UFIFAS on transfer of assets shall be followed. Here, Sister Farida, you need to take a note of it. Here, the footnote is wrong. It is referring to control of asset, not the transfer of assets. I'm hopeful that this error is only in the
PPT only,
not in the text, not in the PDF, but you need to check it. Okay.
Okay, I'll check it.
Okay, now coming to the main accounting part, recognition, measurement, and recognition. Initial recognition. An institution shall initially recognize the participatory investment instruments of a quasi-equity nature when the following criteria are met. 1, A, cash or cash equivalents have been received by the institution under legally enforceable contract meeting the definition of quasi-equity, or when funds received under another contract which is not eligible to be accounted for as quasi-equity in its own or on its own. Brother Majd? Shall be in its own or on its own.
Maybe both work, but maybe grammatically on its own, I feel.
Okay. Okay, Sister Farida, just make a note of it. We'll check with the, we'll request others to provide input on this, or maybe we can, change it to per se.
Per se.
Or quasi-equity per se, I think. We can just take a note of it.
Yeah, much better.
Yeah. So are transferred to or commingled with the quasi-equity becoming eligible to be accounted for as quasi-equity under the requirements of respective FAS. So for example, there was Wakala bil Istismar funds which were received, which were considered to be off-balance sheet accounting, subject to off-balance sheet accounting. But what happened that they were commingled here. So what happens? And one situation is transferred to. So for example, there was a current account. I have a current account in Islamic Bank, and I go to the app and I transfer from my current account to a saving account. So the funds originally were received on the current account, but now they become eligible for this. So there can be different situations in which funds are transferred from one account to another, either by the customer or by the institution. So then they become eligible. And the third situation is respective contract has no precondition to come into effect. So at times the respective contract may say that we are collecting the money, but we will start the investment pool on a given date. So it may apply in case of a sukuk, it may apply in case of an investment account where the investment account is for term nature and it applies after 1 week or 1 month, or it has to start from the beginning of the month, etc. So if the contract has some precondition to come into effect, in that situation, if we will have to wait for that time. If not, then we take it directly. Initial recognition, we are continuing. The initial recognition of the quasi-equity shall be at the fair value of the consideration received on the date of contract becomes effective. Where the institution keeps the fund received for quasi-equity in a current or similar account on a temporary basis, the quasi-equity shall be recognized at the time when the contract becomes effective and the funds are transferred to the investment pool. Accounting for underlying assets. So that was the accounting for the funds received. That is the investment account accounting. Investment accounts payable that is to be recorded by the institution. Now we are talking about what comes on the asset side. New assets acquired by the investment pool and investments made therein shall be recognized, measured, and valued according to relevant AOFI phases, applying the respective accounting policies consistent with the accounting policies of the institution. Assets acquired through transfer from other pools or from owner's equity shall be recognized, measured, and valued according to the Sharia principles and rules and respective regulatory requirements. Brother Majd and Sister Farida, if you can make a note of it, I think in the transfer of assets standard, we mentioned regulatory requirements and the contractual requirements. My comment is only just to align all the three. We need to align with the other standard. Okay.
Yeah.
Explanation. Timing of such transfer and valuation of such assets are considered to be business decisions made in accordance with the relevant Sharia principles and rules. And I believe that one also says and the contractual requirements. Accounting for underlying assets. Accounting and financial reporting for such transfer shall be made according to the requirements of this standard and the respective AOFI FAS. That's the one we are referring to. The institution may choose to keep cash or cash equivalents available in the investment pool to comply with liquidity management policies or contractual arrangements. Brother Mizanur Rahman, this is not the, this is an additional element. That it's not only about keeping the CRR or SLR. This is about if CRR and SLR are to be maintained within the fund or outside of the fund. And it is about if additional cash is to be reserved as for the encashments, etc. So these are the elements are also to be considered here. Accounting subsequent to initial recognition. Subsequent measurement of participating investment instrument of quasi-equity nature at the end of a reporting period shall be made on the basis of underlying assets and performance of the respective investment pool. The following adjustments are generally made to initially recognize periodic balances. Additional funds received during the period, any share of profit allocated and reinvested, withdrawals, investments and maturities during the period, impairments, net of reversals, net profits or losses during the period, transfers to or from the reserves, and institutions' share of profit and loss in different capacities adjusted for hiba, other gifts and prizes, or fee, fixed and or variable as applicable on a net basis. Net profit or net loss determination. The net profits and or net losses of each investment pool shall be computed according to the respective accounting policies of the institution or mutually agreed accounting policies in certain circumstances in line with relevant AOP phases, considering each pool as a virtual reporting entity. Net profits or loss determination. Maybe it's on my eyes, but I feel that the font size becoming smaller on this slide. The following are deducted from the investment pools before the allocation of profits to institution as mudarib or equivalent. Net transfer to profit equalization reserve or other special reserve created specifically for the quasi-equity in line with the requirements of respective AOP phase, that is phase 35. Net transfer to any fair value reserve arising on fair valuation of the underlying assets in line with the requirement of relevant AOP phases, irrespective of being classified as in fair value through income statement or fair value through other comprehensive income, which according to the mutual agreement or according to Sharia principles and rules are not considered presently distributable. Such reserves shall be recorded and represented separately in line with the requirements of the standard. Let me clarify this. B. A is easily understood. B is an important issue. What happens that according to the new phase 1, according to our new accounting standard on like for example, standard number 33, other standards, at times you have fair value gains and losses. Now, those fair value and gain and losses in some of the contractual arrangements with the customers will be distributable and others will not be distributable. So what happens that considering the distributable situation for these, you need to decide whether they will be kept in a reserve or not. So if they are not considered distributable as per Sharia board's view or as per the contractual agreement with the customer, in that situation, it will also be kept as a reserve. So that is actually adjusted from the profits at that point of time. Net profits are appropriated between holders of quasi-equity instrument and the owner's equity in the following sequence: proportionately based on the relative amount of funds invested by the quasi-equity and the owner's equity in the respective investment pool, and out of the proportionate share of quasi-equity as computed according to A above, at any contractual ratio of mudarib share of profit as a prof mudarib or in other capacity as applicable. Just to clarify one thing, this A may have impacts on accounting and it may have impacts on the systems, because we are saying that the relative amount of funds invested by quasi-equity and owner's equity first need to be segregated on proportionate basis. When we say that it has to be done on a proportionate basis, it means that here the owner's equity will not be getting a weightage. For accountants, Sharia compliance guys, Sharia auditors, and maybe system developers, this is a very important point. Now, we believe that this is as per AOP understanding of AOP Sharia standards that we made. But this is actually going to impact some of the distributions. I would like to listen to the experts on the accounting side and the pool management side and the system side, how they feel it, like how they are doing it right now and how they feel it is going to impact. I think we have covered this issue here as well as we have covered the similar issue in the governance standard also, because that is our interpretation of Sharia. Because if you allow the equity or weightage, it gets the double advantage. It is getting double advantage on the equity part, equity contribution part, and then getting a profit out of the mudarba pool part, the amounts related to the urea. So that it is a dual effect, and actually if the weightage is on a higher side, then it results in unjust and unfair treatment. So from that perspective, we believe that the original requirement of Sharia and original, as we see in the AOP Sharia standard on Mudarba, and as we see in other literature like Sheikh Taqiy's books and other places, we find that this is the right treatment. But this is again one of the very challenging issues, because it may need some of the changes in the systems and the accounting and the calculation of profit distribution in the pools, and even the Sharia compliance issues may be there. So this is something on which we would love to have some comments today or in form of written comments. We would like to get some feedback. Net losses are allocated between holders of quasi-equity instrument and the owner's equity proportionately based on the relative amount of funds invested by each party in the respective investment pool. So the losses are always without any weightage. They are to be allocated directly on the proportion of the amount of investment rather than applying any weightages. Appropriated but unpaid profits due to quasi-equity shall be accounted for as follows. Sister Farida, just make a note of it. Instead of due to quasi-equity, I would suggest payable to quasi-equity or attributable to quasi-equity might be better, because due again is a word that can be understood in different meanings. Appropriated but not due for payment shall be considered either reinvested or retained in the respective investment pool with or without eligibility for return in line with the contractual arrangement. Appropriated and due for payment which are not reinvested as per mutual agreement shall be recognized and disclosed as a liability by the institution. Appropriated and due for payment. Here the due for payment to quasi-equity or due for payment is okay, but due to quasi-equity directly in the first line may not be that much clear. So we can say due to payment, due for payment to quasi-equity. I think that would be good. Appropriated and due for payment which are reinvested as per mutual agreement shall be either retained in the same investment pool or may be transferred to another investment pool and reported as quasi-equity, so if so prescribed by the respective contractual arrangement. We have a Q&A comment in Q&A tab. Brother Muhammad, mashallah, is it share of net profit and the mudarba considered like interest, or it is possible to share net profit of mudarba by Sharia? Brother Muhammad, I'm very sorry, I'm unable to fully understand your question. So if I try to read it again, is it share of net profit under mudarba considered like interest? For sure, net profit under mudarba is never considered to be interest. Or is possible to share net profit of mudarba by Sharia? Yes, as per Sharia. I think your question is a very basic question. In a nutshell, brother, the mudarba profit is not a fixed profit. And it is not fixed as a rate on like in a 10% return per annum or something like this. Rather, it is the actual return which is determined. So it is permissible, while interest-based fixed return is impermissible. A part of unpaid or undistributed profits or gains may be set aside from the investment pool in the form of IRR in line with the requirements of S35. In such cases, IRR will remain part of the investment pool till it is utilized or reversed. Sister, utilized spelling, but UK English we need to apply. Okay.
Okay.
Or reverse transferred out to the income from which it was created. Impairment and credit losses attributable to quasi-equity. Impairment and credit losses attributable to quasi underlying assets corresponding to the quasi-equity shall be taken to the statement of income and attributed to the respective investment pools. Just a question, Brother Majd and Sister Farida, just note a question for the working group. Can there be situations where, because the FAS 30 talks about impairment, credit losses and onerous commitments. So can there be situations of onerous commitments that are attributable to the underlying assets? I think there can be some situations. So let's put it as a question to the working group. In that situation, we may consider adding the provisions for onerous commitments here as well. Loss resulting from transaction in an investment pool that is recognized during a period other than that in which financial settlement of quasi-equity is made should initially, where available, be adjusted against available IRR through reversal of IRR, then be charged to the income of the respective investment pool, then if inevitable be deducted from the respective quasi-equity and the owner's equity proportionately according to each party's contribution to the joint investment. Impairment and credit losses attributable to quasi-equity. Loss due to misconduct or negligence on the part of the institution as established in line with Sharia principles and rules shall be borne by the institution and hence shall not be recorded as a loss in the investment pool. Participatory investment instruments. Now I can see a quick Q&A tab. Brother Muhammad Usman Siddiqui has a comment. Should provisioning be made part of the pool expenses, also the treatment for write-offs? Brother Usman, I think I can presume that you are joining us from Pakistan, because some of the Sharia scholars around the globe have a view that you should not be charging provisioning to the pool. Rather, you should be charging only the write-offs to the pool, which means that there is a risk of an element of unjust treatment. So, for example, today, if I know that some of the investments are in default situation, but since they are not till write-off situation, so what happens that for the time being, this hit is taken by the equity, not charged to the pool, and only at the time of write-off it will come, while the event of default has actually happened today. So AOFI has a view that we believe, as AOFI, we believe that the fair treatment for the investment account holders is that you charge the impairment, credit losses, etc., that is provisioning, when based on the best estimates of provisioning on an ongoing basis. And you should not wait till the end. Waiting till the end means that for the time being, the bank is sort of guaranteeing the capital. So we believe that the correct treatment is what is defined in this standard and what is defined in our FAS 30. And I know that some scholars around the globe have this view of taking it on the write-off, and Pakistan Central Bank has taken this view on the write-off. But if you ask me, as I understand Sharia based on AOFI Sharia standards, and as we have discussed this issue with the Sharia committee of AOFI as well time to time, we believe that provisioning must be charged. It is written actually in the Sharia standard as well, right? Because impairment losses should be adjusted when identified based on best estimate, not that we are waiting for like 20 years for the write-off after the court case. So I think I'm able to answer you quickly on that. Brother Sadaqat Khan has made a comment here at 30, credit loss due to management negligence should not be charged to this pool. Brother Sadaqat, it is very clear that credit losses due to management negligence should not be charged to this pool. But this is something which should not be used as an excuse to guarantee the capital. I think again, thanks for joining. You are such a senior person, and every time you join our public hearings and add value to these public hearings by your comments. So while I fully agree with you, but I think you can also understand my point that management negligence should be based on based on establishing under Sharia principles and rules. It should not be like the management says every time, oh, it's our negligence because there is a credit loss, so it's our negligence, so we take the hit. Sorry, it's about guaranteeing the capital. And if they are so nice that they are taking the hit, then Brother Sadaqat, let me put another angle to it. The management is the agent of the shareholders also. So shareholders were not at fault. It was management at fault. So you should take this money, this loss from the salaries of the management, because they are agents of the shareholders also. So they become very kind on behalf of shareholders. Oh, we did the negligence, so we take the hit. Okay, shareholders did not do any hit, did not do any negligence. Maybe their negligence was to appoint you as management, but they actually appointed you as agent. So if you did a negligence, it's not shareholders' fault. Then it should be paid out of your salaries. What do you think about my comment, Sadaqat Saab? So Brother Usman Siddiqui, in a nutshell, my comment as per AOFI Sharia and accounting standards, we should not be waiting for write-offs. At the time of provisioning, based on the best estimate of provision, we should record the provisions. Only one thing is there, that if a general provision is there, should that general provision be charged? So the point is that the general provision, we believe, if the general provision is based on the best estimate of losses, like in the case of IFRS 9 and case of FAS 30, that we do we do a estimation of expected credit losses based on a proper mechanism, very complicated and comprehensive, sophisticated mechanism. In that situation, that is a just and true fair treatment that that provision should also be charged to the investment pool. So in a nutshell, our answer, yes. And in case of write-off, if the full provisioning is done from time to time, then eventually the write-off will not come to the pool. Rather, it will be write-off will be against fully provided amount already. So, but again, write-off will come to the pool if it was not already provided for. Brother Misbahullah Fatah, he has said salam, walaikum assalam, brother, but we are waiting for your question. Brother Farid Karkhabi, regarding 31C, if we know that it's inevitable to top up losses from owner's equity and taking it the hit due to respect of expected profit advertisement, should then that known inevitable obligation be taken in the calculation of CAR? Nutshell, yes, there is a displaced commercial risk, Brother Farid. That displaced commercial risk is to be adjusted for. Displaced commercial risk is for that displaced commercial risk, you might need to have reserves as well. So if you have adequate reserves available, then the issue of CAR will not come. But in case of capital adequacy ratio, that is CAR, as I mentioned earlier, that there should be alpha factor. The alpha factor is the expectation level that the bank will be making good will be applying some profit smoothing techniques. Now, the profit smoothing techniques have so many Sharia non-compliance issues. Even HIBA should not be a common practice. These are the things that we are trying to address less in this accounting side. In this accounting side, we have asked for disclosure and everything. But on the governance side, we are trying to address that issue. So first thing is, answer to your question, yes, it should be considered in calculation of capital adequacy ratio by way of adjusting the by way of adjusting through the alpha factor. So the regulators should keep it into mind. The second part, is it a good practice? No, I don't think it's a good practice. Yes, profit smoothing has some good approaches. HIBA is not the good approach. Having a good reserve system is a good approach. If you have good reserves, then because those reserves will also be serve the purpose of capital adequacy. So maybe you might not need an adjustment for capital adequacy ratio. But personally, I believe profit smoothing shall be done by having adequate reserves mechanism, adequate provisioning mechanism, and not by arbitrary HIBA, which at times is very close to riba, in my humble view. So in a nutshell, the answer is yes, but yes, it's not a very good practice. And this need to be improved. We are trying to improve it from Sharia side. We are trying to improve it from accounting side. And more importantly, now we are working on this governance of investment accounts standard, which is actually going to address some of these issues in more detail. Thank you very much, Brother Farid, for an excellent comment. Mr. Farida, somehow I am not finding slide numbers on this one. So I need to see on which slide number I have reached actually. So slide numbers are also missing. And this presentation actually, the font sizes are changing and slide numbers are missing.
Okay,
so
we are de-recognition.
Sorry?
We are on de-recognition. I think there's it's a lot of paragraphs on this, but I think we are on de-recognition, bit after de-recognition.
Oh, actually, I missed. No, we were there. 30, 31. We were 30,
yeah,
on 31.
This,
No, we were on 31.
31.
We were on 31. We were right at 31 because I was addressing answers on 31. Now, loss due to misconduct and negligence we discussed about already. De-recognition now, 33. Participatory investment instruments of quasi-equity nature are recognized when they satisfy the following criteria. A, the equivalent value of the underlying assets, either as per the constructive liquidation according to the respective accounting policies, or the exit value as mutually agreed in line with the terms of the contract is determined and fully settled and discharged by the institution or transferred to another account on the instructions of the quasi-equity holder. And the underlying contract is terminated and there are no further legally enforceable obligations. Revocation of the contract. If the underlying contract of quasi-equity, for example, Mudarba contract, is revoked due to non-fulfillment of its terms and conditions by the institution, returning the funds become a liability of the institution kept on trust till repaid. The same shall be transferred to and reported as liability. The value of the fund on the date of revocation shall be measured in accordance with paragraph 33A. Commingling of al-wakala bil istismar. As I touched upon this issue earlier, that this is one of the new issues that was not there in FAS 27, and it was introduced originally in FAS 31. An institution acting in the capacity of an agent may maintain multi-level investment arrangement. An example of such arrangement is the investment of funds received by the institution through al-wakala bil istismar arrangement by commingling the funds in the investment pool managed by the institution on a mudarba basis. In such a case, A, the funds received under the Wakala bil istismar investment agency arrangement invested in the sister Farida. Wakala bil istismar and investment agency should be a consistent practice. Okay, either we use it everywhere or we don't use anywhere. Noted?
Okay. Yeah,
okay.
Yeah, I'll write this down.
I think the name of the standard has it. But other than that, I think we should not be using it everywhere. Only in the definition we should use it, not after that. Or first place where we use it, not after that. The funds received under the Wakala bil istismar investment agency arrangement invested in the investment pool shall be considered as an investment made by an investment account holder. Account holder, I think, just consistency purposes, sister, I think account holder, we are keeping it combined as a single word. Am I right?
Yes. I'm adjusting.
So here it is not appearing as a simple single word. Being the principal of the investment agency arrangement in this case, the investment agent has merely taken a decision about where to invest these funds. The funds invested or commingled in the investment pool shall remain under the ownership of the principal, who shall be responsible for any risk or reward consequent to the investment. Commingling in such a case does not signify control over the funds. And in line with the requirements of paragraph this of FAS 46, the profit of the Mudarba investment pool will be shared between all investors, including principals of the investment agency, according to the standard method of profit allocation. The primary transaction of the arrangement referred to as paragraph 36 shall be recognized in line with the respective AOFI FAS. The secondary transaction where the Wakala bil istismar is being commingled in the investment pool shall be recognized in the book of the standard as part of quasi-equity in line with this standard. Quasi-equity, sukuk, and other instruments. There is a rebuttable presumption that sukuk is structured on musharaka and mudarba basis shall be classified as quasi-equity if they do not meet the criteria of classification as equity or for accounting as of balance sheet asset under management. These criteria are provided in FAS 29. FAS 29 we issued earlier as exposure draft, then we issued again as exposure draft. So FAS 29 is in exposure draft stage. Sister, it will be still good if we can put a reference to the exposure draft of FAS 29. Okay.
Okay.
Certain sukuk is structured on the basis of al-wakala bil istismar that do not meet the criteria of off-balance sheet accounting shall be classified as non-balance sheet quasi-equity sukuk if they meet the criteria described in paragraph 15. The accounting treatments prescribed in respective in specific AOFI FAS applicable to sukuk issuance shall be, again, that is FAS 29. So again, sister, you in respective AOFI FAS, I think in respective AOFI FAS it should be, sister.
Okay.
Okay. Shall be applicable in priority to the requirements of this standard. In the Q&A tab, we have a comment from J. Velulana. Is perpetual sukuk classified as equity, quasi-equity, or a liability? An excellent question. According to FAS 29 exposure draft and according to FAS 1, phase 1 actually has it because phase 1 is in effect while exposure draft of phase 29 is not in effect, although it discusses the matter in more detail. In a nutshell, according to the definition of AOFI, which is quite similar to the definition under IAS 32, if a sukuk has two elements, one of the two elements or a combination of two elements. Number one, it does not have a put option, means that it is perpetual. Then it is considered equity because there is no perpetuity. Now, perpetuity makes it quasi-equity because if you have a put option, these sukuk have the residual interest in the underlying asset. All sukuk have residual interest in the underlying asset. So the question is, do they have the equity element? So if they do not have a put option, if they do not have a maturity, if they do not have a put option of encashment or redemption, then they become equity. But second condition is convertible. So the definition that we have used in the relevant standards talk about perpetuity and redemption option. So, but the main condition is perpetuity or redemption because they do not remain perpetual, but they are redeemed into, sorry, not redemption, conversion, that they are converted into, so perpetuity or conversion option into common shares, common equity. These are the main two conditions. These conditions are quite similar to what is there in IAS 32 and in other IFRS. IFRS has more details on that. But what we have defined is that the sukuk which have these requirements will go to equity. I think for now, we cannot go in more detail about this subject. In a nutshell, this is the answer. Certain sukuk based on, sorry, 40 is done, we discussed. The accounting treatments, I think we discussed all the 3 paragraphs. Okay, let's move. Other instruments of quasi-equity. General requirements of the standard shall apply to all types of quasi-equity. However, the following specific requirements shall be applicable on other instruments of quasi-equity. A, other instruments of quasi-equity. When we talk about other instruments of quasi-equity, Sister Farida, we need to clarify here what is meant by other instruments of quasi-equity. Actually, we are talking about instruments of quasi-equity other than investment accounts and sukuk, which are already discussed. Am I right? So maybe we need to clarify here that what we are referring to here. Okay? General requirements of this standard shall apply to all types of quasi-equity. However, the following specific requirements shall be applicable on other instruments of quasi-equity. That is the instrument which are not unrestricted investment accounts or not sukuk. Other instruments of quasi-equity shall be separately disclosed in the financial statements, and their terms and conditions shall be disclosed in case the instruments are material in amount. Currency for quasi-equity. Again, currency for quasi-equity is one of the issues that was not, this was addressed in our Musharaka standard. AOFI's Musharaka standard on Sharia standard on Musharaka addresses it. Other standards do not clarify this issue very clearly. But again, this is one of the challenges that we have seen in Sharia compliance of investment accounts, that if you combine multiple currencies in one pool and you do not adjust the original values, in that situation, you are guaranteeing the capital partially, which is against Sharia. So we have put in as a very important requirement here that quasi-equity instruments, including investment accounts, might be denominated in different currencies. In case of application of more than one currency, the institution shall clarify the currency of each investment pool, whereby the quasi-equity denominated in each currency shall be attributed to the respective investment pool only. Generally, all underlying assets of the respective investment pool shall also be denominated in the same currency. In case where the currency of investment pool is different from the currency of denomination of the quasi-equity or the currency of denomination of one or more of the underlying assets, the following shall apply. Any underlying assets in a different currency shall be converted and accounted for in respective currency for the investment pool, whereby any exchange difference on the translation of underlying asset on periodic basis for the purpose of constructive liquidation shall be attributable to the investment pool, which means that you cannot guarantee as a bank, you cannot guarantee that conversion element, which was a practice of some of the institutions. Any quasi-equity shall be converted in the respective currency of the investment pool once received, and henceforth shall be accounted for in a manner as if it was always in the currency of the investment pool. Any withdrawals and maturities shall take place by converting the respective balances in the currency of the investment pool to the currency of original investment if required contractually at the rates of exchange prevailing at the time of withdrawals of maturities. So the pool, let me take an example. If we take example of Bahrain, it is easy because the US dollar is pegged with the Bahraini dinar. So here I'll keep my investment pool in Bahraini dinar or in US dollars, and currency which comes, whatever currency comes in, I will convert and put in the same pool, not a problem. Every time I will convert and then I will reconvert, it will not be a problem. But let's take an example of another country, like let's take example of Turkey, where I have deposits based on US dollar or euro, and I have deposits based in Turkish lira. I cannot combine them together in one. If I combine them in one, so first preference is do not combine them in one. But if I combine them in one, then it means that depending on the currency, every time that change will have to take place when you bring in money or you take out money. And any exchange gains or losses on the underlying asset related to that pool will also be attributable to the profit and loss of that investment pool. This is to ensure one of the major to avoid, one of the major Sharia non-compliances that we have identified. That is an accounting issue and a Sharia issue, which is to be addressed by this paragraph 43 and 44. Presentation and disclosures. Now, presentation and disclosure requirements which were there in our earlier standard FAS 27 mostly have been kept intact. Obviously, we have improved some of the requirements. So the quasi-equity, including the investment account, shall be presented in the statement of financial position of the institution placed between the liabilities and owner's equity, categorized into line items based on the respective nature of the instruments and their materiality. Now, there is one major issue, major change, not issue, change, that our new framework and new FAS 1, they brought in a concept of having a statement of income and attribution of quasi-equity. This is important because we believe that the banks and Islamic banks and similar financial institutions have a unique business model in which the users of the financial statements include the investment account holders, and these they need to know reasonable information about the performance of the investment accounts and the underlying assets. So from that perspective, this statement of income and attribution to quasi-equity is very important. An institution shall prepare and present a statement of income and attribution to quasi-equity in line with the requirements of respective FAS, that is FAS 1, as well as the requirements of this standard. The general disclosures prescribed in FAS 1 shall be applicable to the quasi-equity accounts and other instruments anyway. Accounting policies in respect of following matters shall be disclosed. The basis applied by the institution in the allocation of profits between different stakeholders, including Mudarib and restricted investment accounts. The basis applied by the institution for charging expenses to URIA. The basis applied by the institution for charging provisions, including impairment. System, again, I think we should say impairment, expected credit losses, etc. We need to make consistent, as I made a note earlier as well. So here also we need to make that note. The funds in the nature of current accounts by the institution that are invested in investment pool, the basis of giving priority to party owners equity or quasi-equity while making investments in case of investment is unable to utilize its fund. The institution is unable to utilize all funds available for investment. So what is the priority, like, in case of excess liquidity? Policies related to transfer of asset between investment pool and different categories of stakeholder in line with requirement of relevant FAS, different types of FIBA, other gifts and prizes. The parties to whom non-performing accounts revert once they are no longer required. I think this is the term here, non-performing account, need to change the provisions for. So that again, it has to be referred to the investment of non-performing accounts. Okay, I think we need to improve this wording. It has to be aligned with the impairment, credit losses, etc. The following significant information shall be disclosed: description of the range of products and general characteristics of investor to whom these products are suitable for, brief description of account opening, redemption, and distribution of profit mechanism, governance and Sharia compliance. Sharia spelling, sister. Sharia compliance arrangements applicable to the quasi-equity accounts and instruments, investment policy to establish reserves, including prudential and/or policy for creating and maintenance of PR, IRR, and any other reserve. Following disclosures shall be made: the minimum percentage of quasi-equity account that the institution has agreed to account holders. Account holders, again, as a single word. Consistency is needed here. to invest in order to produce returns for them. Total administrative expenses charged to quasi-equity accounts, along with a brief description of their major components. Charged to quasi-equity or quasi-equity accounts. Again, I think I just want consistency, so just make a note of it. We need to make sure consistency on this, so keep it highlighted. Minimum and maximum weightages for profit allocation between Mudarib and quasi-equity accounts that were applied in the current financial period in case where amounts were material. The percentages of profit charged by the institution and Mudarib during the financial period in case where the current accounts have been included in a Mudariba pool for investment purposes. The return earned on these current accounts and respective allocation, whether it is to be allocated between equity and in quasi-equity both, or only for equity. So that is something that we need to clarify. The type, amount, and basis of sharing of revenue in case where the institution is sharing revenue from banking operation, for example, fee and commission income, etc., with quasi-equity accounts. In case where the institution is unable to utilize all funds available for investment, the party to whom priority was given owner's equity was quasi-equity while making investments and among the investment pools. Okay, there's 48E and 49G. First one is about the basis and second one is about the disclosure. But I think we just need to make sure that there is no overlapping. Just make a note of it to make sure that we align the wording in a way that there is no overlapping. In case cash or cash equivalents are kept as asset for the investment pool related to quasi-equity as a regulatory requirement of for liquidity risk management purpose in line with the relevant agreements, contractual arrangements. We use the term contractual arrangements, not agreements. The ratio and or the amount of the same, and the amount and description of any incentives hiba over and above the expected profit received by the Mudarib, if any. I can't see any comments. I think either people are all okay with these disclosures. I was afraid that there will be comments that some of the disclosures are too cumbersome, but maybe everybody is happy with them. So maybe we'll take a note of it that everybody is happy with them. Brother Farid has another comment. Should the alpha be used in car also be disclosed? Brother Farid, actually, this is an accounting part and not the disclosure part, but I think it's a good comment. Because a question is that it should not be disclosed here, but it should be disclosed in the risk and capital related disclosures towards the end of the disclosure. So they are not the part of disclosure here. So I believe alpha used in car should be a disclosure. I fully agree with you, but I believe it should not be a disclosure here. It should be a disclosure in the relevant risk-related sections of the disclosures under phase 1. Sister Farida, please make a note of it. It's an excellent comment. We might need to put it here or we need to put it somewhere else, but maybe we need to add it. We need to check if we have put it in the illustrative financial statements or not. It should be there in the illustrative financial statements as well. So I think that we should be adding it to both places. I think maybe we can put a disclosure requirement here as well. There is no harm in putting if it is not there in phase 1. So there is no harm in putting it here, but we can refer to it as in a footnote that although the requirement is here, but it can be provided in the relevant risk related sections rather than the quasi-equity related sections. But disclosure is relevant and important. Thank you very much. Brother Muhammad Jasimuddin has made a comment that he has appreciated the presentation. Thank you very much, Brother Muhammad Jasim. Brother Farid has another comment. It may help the depositor to know that 35% of his capital is guaranteed or 35% only. It's an excellent point, Brother Farid. I fully agree. So we can put this disclosure here or there, but the disclosure has to be there. This actually takes me to another disclosure. which actually we have covered that thing in the governance standard on which again the exposure draft of that one is not yet issued. It's towards finalization stage. Another review of the Sharia of the governance board is needed. But I think the deposit insurance scheme and the deposit takaful scheme. So if there is a deposit takaful scheme, we have not asked a disclosure here. So I think the capital adequacy ratio and the deposit takaful scheme related disclosure should also be made here. Thank you very much, Brother Farid. So Sister Farida, please make a note of this capital adequacy ratio disclosure as suggested by Brother Farid and the deposit takaful or deposit insurance scheme as I suggested. Both of these disclosures are related to risk, but those must be made in the financial statements either with the note of the note related to quasi-equity or in the note related to risks. Brother Sadaqat Khan has a comment on 50C. I suggest that minimum and maximum weightage percentages should be defined by OFI since the I5 management plays with this area. Thank you very much, Brother Sadaqat. An excellent comment. We have put that minimum and maximum weightage recommendation in the governance standard. It's not an accounting issue. As accountant, we cannot, in the accounting standard, we cannot say put this much weightage and don't put this much weightage. We can simply say disclose how much weightage you applied. But in the governance standard, we can say that as a matter of good governance practice, or if in order to ensure just and equitable treatment between the parties, you need to put this much disclosure, this much weightage capping or flooring. So that is actually included by us in the exposure draft, which is being finalized. And would love to have your comments on that part as well. Thank you very much. No disagreement on this part. Only disagreement is that accounting standard is not the right place to put it. Thank you again. Your comments are always very valuable, sir. This following quantitative ratio shall be disclosed. The ratio between total PR and total IRR to total investment pool distinct from each investment pool, ratio of profit distributed to by each type of participatory investment account, and sorry. I think Sister Farida here again for consistency purposes, I think we need to use the quasi-equity account term, not the participatory investment account. Average rate of return of participatory investment accounts classified on the basis of HOD. Again, I think it's only for consistency purposes, we need to use the uniform term, that is the quasi-equity account or quasi-equity. Disclosures further, para 52, following disclosures shall be provided for the commingled Wakala bil Istismar. The amount of Wakala bil Istismar funds commingled in the first AT should not be capital. Okay, the amount of Wakala bil Istismar funds commingled in the investment period as at the end of the period, the amount and rate of profit distributed to such funds classified for such individual investor unless undue cost and resources are required to collect such information, the amount of Wakala fee, both fixed and variable, receivable against the commingled Wakala bil Istismar by the institution, and the amount of any additional profit, heba, other gifts or prizes distributed to the commingled Wakala bil Istismar. Now, coming to the effective date, all of these standards together will be effective on 1st January 2025. We intend to finalize them by the end of this year. So there will be still, from the time of issuance of exposure draft, there will be more than 2 years for preparation. And from the time of issuance of final exposure draft, there might be 1 year for preparation. Effective date is a very important element, and the market participants have to provide their input with regard to this thing, that whether they feel that this would be practical but to issue by 2025, to apply it by 1st January 2025 or not, or should the UFI accounting board consider providing further time for that. So amendments to other standards, it will supersede FAS 27 along with the off-balance sheet standard. I think with that, okay, this is an extra slide which should not be there. So with that, we just come towards conclusion. Before conclusion, I would like to take all the remaining pending questions. Dr. Najdat Sanswai, Assalamu alaikum assalam. Thank you very much for being there with us. And actually, brother Mike, Sister Farida, please, we should always promote our honorable members of Board of Trustee and senior members of the Accounting and Governance Board, etc., to be part of the panel, so that even if they want to make any comment by audio, they can make it. So as the time is a little bit there. So what I suggest that first you can allow Dr. Najdat Sensoy to say whatever he wants to say by promoting him as panelist. And as there were 1 or 2 hands raised earlier, and I said that we will see if towards the end we have some time available. In that situation, we'll allow you to make comments by audio or by video. So with that, I think we should be now allowing Dr. Najdat and others, if they want to say something in the participants window. And I think before that, I would I should first come to Sister Amal as well, that she is the chairperson of the working group and a member of the board. If she has any comments, any notings, any important considerations that she want to mention. So first to Sister Amal. And then if somebody promotes Dr. Najdat, we listen to him and any other participant who wants to say something.
Thank you, Brother Omar, for your effort. I haven't any comment additional about my colleague say. We hope to issue this standard at least the end of this year, I hope.
Inshallah. Dr. Najdat has made a comment. We observe a rational evolution in the investment account. Doctor, yeah, it is noted, but Dr. Najdat, you can speak now as well.
Assalamu alaikum, dear brother Omar.
Wa alaikum assalam, and thanks for joining again. It's highly appreciated that senior people like you actually take out time to join these events. It's very, very important for us.
Today we listened to exposure draft, very important change or evolution on investment accounts. This new concept, quasi-equity concept, is very important. One place in the exposure draft, it is mentioned that participatory investment instruments can be quasi-equity nature. It is said quasi-equity nature participatory investment instruments. My question is, what about non-quasi-equity nature participatory investment instruments?
Actually, off-balance sheet investment instruments, participatory instruments can also be there. There is restricted investment account, which is participatory in nature, but it is not quasi-equity, rather it is off-balance sheet. So that is one situation, sir. Similarly, Wakala bil Istismar can be in participatory nature as well. There are arguments about that, but we haven't put it. Then there can be some quasi-equity accounts like Tier 1 Sukuk, that because of being perpetual in nature or convertible into ordinary share, instead of quasi-equity, they become equity, although they are participatory instruments. So while we understand that major type of participatory instruments are all quasi-equity, but there are some of them which become off-balance sheet or which become equity.
Thank you, dear brother.
My pleasure, sir. My pleasure, sir.
Also, this exposure draft is very relevant to the another exposure draft titled control.
Yes, sir.
These two are
there are actually 4 standards. First is this quasi-equity. Second is off-balance sheet investment accounts. Third is control. And fourth is transfer of assets. So there are 4 standards which are part of this whole project.
Yes.
If you put them all at one place, it will be too much and everything will not be relevant to every type of thing. So control actually is itself important because it impacts so many different standards. So we decided to keep control separate and off-balance sheet and on-balance sheet separate. And so that actually we try to keep focused on one topic in one standard, because otherwise it was supposed to become a very big standard and finding the right things would become very difficult. Similarly, transfer of asset is mainly for quasi-equity, but it applies on others as well. because mainly it is quasi-equity pool-to-pool transfer, but there are other types of of transfer of asset which are not quasi-equity. So we covered that one also separately. It was already separate standard, so we made it still the revised standard is separate.
Thank you, brother Omar.
I can see
I
please.
wish Rafi to enhance the standards and make evolution.
Thank you very much, sir. Thank you very much, sir. I just saw a comment from a participant that the voice was not clear. So let me ask the participants if other participants also had an issue with the voice. If they had the issue with the voice or sound or anything, it will be good if they can put in the chat window, so then our team can take a note of it and in future can resolve that issue. Or maybe it was issue with one of the participants only in that situation. I think. Okay, Brother Islam says no major issue, inshallah. Thank you very much, and good to see you, Brother Islam, as well. Okay, so with that, I think if we can conclude, if there are no more further comments coming or questions coming, Brother Majd, I think we can conclude. Please, back to you.
Okay, sure, brother. Thank you very much. First of all, we'd like to thank IUFI Secretary General, Brother Omar Mustafa Ansari, for the interesting session and for all the answers that he provided, all the explanations he also provided on this very important exposure draft that constituted part of FAST 2027 redevelopment project. We would like also to extend our sincere thanks to all our board members, the respectable Dr. Nejat Sinsoy from Turkey and Ms. Amal Al-Masri, accounting board member. She joined us from Syria, Damascus. We would like also to extend thanks to all our supporters and partners in Russia, Mr. Rustom Bakhitov, the co-founder of Academy of BEPS and member of the Association of Russian Experts in Islamic Finance. Thank you, Mr. Rustom, and we also extend our sincere thanks and appreciation to our sister Madina Kali Molina, also from Russia, the National Research University, Higher School of Economics. We would like to thank you all for your support and coordination, and we look forward to seeing you again and again in the future in our future public hearings and other events. Thank you very much. We also extend our thanks to all the participants for their valuable comments and participation. Thank you very much. Take care. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much. We are honored to be invited and surely
Assalamu alaikum. Thank you, everybody. Assalamu alaikum, Brother Rustam, and looking forward to meet you, inshallah, next time. Assalamu alaikum, everybody.
Assalamu alaikum.